The air inside the Dutch factory feels wrong. Not loud, just wrong. Conveyor belts frozen mid-cycle, white suits standing motionless, and the sound of ventilation echoing like a heartbeat. Then a voice over the intercom, clipped official, announces that the government has taken control. No warning, no vote. Within seconds, a Chinese-owned chipmaker becomes state property. Half a world away, the U.S. Treasury flickers under fluorescent light. Scott Bessent staring at collapsing peso charts while oil tankers reroute off Singapore. 3 crises, 1 pattern. What if Washington's control over money, chips, and energy just snapped, all at once? Nexperia, owned by China's Wingtech Technology, produces billions of chips annually for Europe's automotive and power industries. But on that October morning, its assembly lines went silent. According to Reuters, the Dutch government suspended the company's board and transferred decision-making power to court-appointed administrators. Chinese state media called it industrial theft under diplomatic cover. European officials framed it as security necessity. The clash over phrasing hinted at something larger, a shift in who defines ownership in a globalized economy. Within hours, Beijing's Ministry of Commerce retaliated. Export permits for Nexperia's chips to the Chinese mainland were abruptly suspended. BMW and Volkswagen, among others, scrambled to reroute their supply chains. If this isn't reversed quickly, Europe's car production will feel it within weeks, warned Hildegard Müller, head of the German Automotive Association. Her words carried the calm panic of someone who has seen a supply line snap before. The Dutch economy minister insisted the move was sovereign, yet court filings showed prior consultations with the U.S. Commerce Department. That admission peeled back the facade of independence. Washington's tech containment framework had become a transatlantic reflex, allies framing coordination as autonomy. The logic was clear. No single act defines the policy, but together they form a blockade by design. In Beijing, a spokesman for the Ministry of Commerce issued a statement broadcast across state networks. Europe speaks of the rule of law, yet governs by instruction. If supply is weaponized against China, we will answer through industry. Within 48 hours, customs inspections slowed gallium and germanium exports to Europe, delaying 2 essential inputs for chip production. It wasn't a ban, it was a pulse check on dependence. Factories from Eindhoven to Stuttgart began reporting delays. Bloomberg Intelligence estimated potential European production losses exceeding €500 million if the standoff persisted into December. Meanwhile, ASML's shares slid, reflecting investor anxiety that the Netherlands had stepped into a geopolitical minefield disguised as a corporate intervention. And yet, across the Atlantic, another crisis was brewing under the buzz of fluorescent lights and the smell of stale coffee inside the U.S. Treasury's late-night briefing room. Scott Bessent, America's Treasury Secretary, was hunched over a stack of printouts. Peso exchange rates, inflation models, IMF spreadsheets. The room tense as aides whispered about bond yields. Hours earlier, he had announced a $20 billion swap line with Argentina, calling it a stabilization bridge. The aim: defend the peso, keep China from deepening its economic foothold in Latin America, and protect U.S. access to Argentina's lithium fields. The gesture had political flair. Argentina sits atop the world's second-largest lithium reserves, the light metal essential for electric vehicles and chip batteries. But, markets are deaf to diplomacy. Within days of the announcement, the peso fell again, erasing half of Bessent's intended stabilization effect. Bloomberg described the move as an intervention colliding with arithmetic. Inflation in Argentina topped 260% that month. Traders dumped pesos for dollars. Even Argentina's central bank sought a waiver from the IMF for missing its reserve accumulation targets. A Financial Times analysis warned that Washington's bailout might simply finance Argentina's continued import dependency, a dollar rescue sustaining the very fragility it seeks to fix. Inside the Treasury, aides debated whether to double the line or let the losses run. One described the mood as half caffeine, half denial. Bessent defended the program as geopolitical insulation, not charity. "We can afford volatility," he told staffers, according to a transcript later cited by the Wall Street Journal. "What we can't afford is Beijing buying influence 10 cents on the dollar." But spreadsheets told a different story. The peso was down another 2% after his Oval Office briefing with President Trump. Reuters later reported that internal Treasury models showed unrealized paper losses exceeding $800 million within 2 weeks. The swap's collateral was denominated in local currency, rapidly losing value. Even sympathetic analysts called the plan a geopolitical hedge without economic footing. The irony wasn't lost on traders. In a market built on faith in U.S. fiscal strength, Washington itself was now propping up a collapsing currency. For all its intent to preserve influence, the policy revealed an uncomfortable truth: political defense of the dollar sometimes requires spending it faster than it can be justified. At that same moment, the global energy map was redrawing itself. Canada's crude exports to China reached record highs in October. Roughly 70% of British Columbia's outbound shipments, according to the Canadian Energy Regulator. U.S. imports from Canada, by contrast, fell sharply. The discount American refiners once enjoyed, 5 to 15% below global benchmarks, evaporated. Ottawa's pivot eastward meant Canadian producers could sell at higher margins to Asia, while U.S. refiners faced higher costs and fewer barrels. Then Beijing moved again, this time on the sea. Chinese port authorities imposed new docking fees on vessels flying U.S. flags. Freight rates spiked 12% in a week. Reuters estimated the new levies could add up to $7 a barrel on some routes. The justification sounded bureaucratic, port infrastructure maintenance, but the timing was surgical. U.S. oil shipments to Asia became instantly less competitive. Gulf Coast exporters began delaying departures, citing unpredictable costs. Traders in Singapore adjusted pricing formulas overnight. In Europe, refiners turned toward Middle Eastern suppliers to hedge against volatility. The effect was swift and asymmetric. China was now taxing U.S. exports without ever calling it a tax. Meanwhile, Washington's own numbers were slipping. The Energy Information Administration projected record output of 13.5 million barrels per day in 2025. Yet federal revenue from oil production on public lands had fallen 10% to $16.4 billion. More barrels, less money. Economists at the Wall Street Journal labeled it the abundance trap. Pumping faster was no longer translating to fiscal strength. Back in The Hague, the Nexperia standoff showed no sign of easing. Dutch-appointed managers struggled to access software keys stored on servers in Shenzhen. Chinese legal teams refused to recognize the transfer of authority, arguing it violated bilateral investment treaties. "We are observing a replay of colonial behavior," said Chen Wenling, chief economist at China's Center for International Economic Exchanges. "When Europe cannot compete technologically, it seizes by law what it cannot produce by innovation." Her comments spread across social media, resonating far beyond trade specialists. European leaders privately admitted unease. If the Netherlands could expropriate Chinese-owned assets under security pretexts, what prevented China from reciprocating against European holdings in Asia? Diplomats feared a tit-for-tat spiral that could engulf industries far beyond semiconductors, batteries, pharmaceuticals, even aviation. By early November, the U.S. Treasury's Argentina experiment looked increasingly untenable. Peso liquidity was drying up, and IMF monitors warned that reserves were again below target. A confidential memo cited by Bloomberg noted that U.S. exposure could reach unsustainable optics if the swap line is extended beyond December. In plain terms, the bailout might become a write-off. In the energy market, crude prices slipped 2% as global demand softened. U.S. producers cut 23,000 jobs in the first 8 months of the year, according to Labor Department data. Energy economists pointed out that shale output, though high, was approaching geological limits. The technological efficiency gains that once defined the boom were flattening. Record production was colliding with physical exhaustion. By late month, the pattern crystallized. In Europe, chips seized. In Latin America, currency rescues bleeding. In the United States, oil revenues falling despite surging output. Every action meant to consolidate power was now eroding it, not by rebellion, but by arithmetic. Diplomats in Brussels floated the idea of a new strategic autonomy fund to shield European industries from U.S. influence. China expanded its port infrastructure financing in the Middle East, quietly buying equity stakes in terminals once dominated by Western firms. Argentina's peso limped toward another devaluation as the IMF demanded deeper reforms. None of these moves were dramatic individually. Together, they formed the architecture of a new balance: slow, precise, irreversible. China is now preparing something even sharper. Customs officials have begun circulating an internal directive labeled Phase 2 Export Controls, a framework extending beyond rare earths into lithium salts, gallium nitride, and high-purity graphite. Bloomberg analysts interpret it as a live stress test on Western supply resilience, not a full embargo. Yet every customs slowdown already translates into billions in market anxiety. Lithium carbonate prices in Shanghai futures jumped 8% in a single trading session on rumors of license restrictions. In parallel, Europe's banking sector is flashing red. The European Central Bank's emergency bulletin shows corporate loan demand collapsing at the fastest pace since the 2008 crisis. That matters because semiconductor expansion depends on cheap capital. Without it, the EU's drive for tech sovereignty stalls before construction even starts. Fitch Ratings now warns that if chip plant delays exceed 6 months, regional GDP could shave off a quarter point. Meanwhile, energy traders are watching a new choke point, the Strait of Malacca. Satellite data reveals Chinese-flagged tankers clustering near the Singapore corridor, likely rerouting crude bound for the United States. If confirmed, this rerouting would divert nearly 5% of global oil flow, enough to tilt freight prices worldwide and push Washington's energy calculus into open crisis. Back at the Treasury, as another long night stretched past midnight, the tense aides huddled at Bessent's desk. The hum of the air vent masked the faint rhythm of his pen tapping against a memo titled Emergency FX Operations, Latin America. Outside, Washington slept. Inside, the world's reserve currency was being defended by exhaustion. By December's first week, European automakers had begun rationing chips, and Dutch regulators admitted the Nexperia seizure might extend indefinitely. The U.S. Treasury swap losses exceeded $1 billion on paper, and federal energy receipts showed another 3% monthly decline. 3 crises. One thread control had become costly. What happens when the very tools meant to enforce global order, chips, currency, and oil, start eroding the leverage they were built to secure? When allies must seize, rescue, and overproduce just to hold position, does dominance still pay for itself? According to the latest IMF Global Fiscal Monitor, U.S. net public debt is projected to reach 126% of GDP next year, its highest level since World War II. The number lingers like a closing bell. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.